Let's find out how things are trending when it comes to IT. What is going to be the long-term outlook? Which are some of the stocks to watch out for? How will the macro factors affect it? And joining in is Vibhor Singhal, who is the director, Nuvama Institutional Equities, and tracks this space closely. Thanks so much for taking time out. I'm just going to start off with the basic sectoral stance that you guys have on IT, and that is doubling down on a positive stance. What is making you so positive?
So yeah, thanks for having me on your show. Look, I think our stance on the IT sector has been positive for the past 2 years. We've maintained that the demand environment remains quite strong, which is visible in the deal flow that we've seen over the past 2 years, despite the macro headwinds which the sector had witnessed. What was missing in the sector was the deal flow to revenue conversion, which of course had multiple points, two of them majorly being the new deals being awarded were delayed in execution, and the older deals which were there in the pipeline of the companies, the discretionary part of that was being put on hold. This was both these things were an outcome of the overall uncertainty in the macro environment in US. So from a near to medium term perspective, we believe that as we move closer to the interest rate cut scenario in US, this uncertainty is going to get removed. Going to get more and more clarity on the spends front for the corporate clients, and that is going to drive the revenue growth for the company in the near to medium term. For a medium to long term, we've done a very extensive analysis of how the Gen AI opportunity is going to play out for the Indian IT sector. And we believe it's going to be a mammoth opportunity for all the players in the domain. We've compared it to multiple technology disruptions which have happened before in the past. Every time there is a new technology, industry experts have called out the doomsday for the Indian IT and have written the obituary for for the Indian IT companies. But every time there's a new technology disruption, the Indian IT companies come out stronger from it with net incremental growth from using that opportunity itself. I think Gen AI is going to be no different. I think we're going to see the next 2 years are going to be the hit and trial kind of phase in which you will have a lot of POCs and smaller projects. But as time plays out, as the technology matures, as it becomes ubiquitous, as companies understand the pros and cons of it, I think the Indian IT companies will once again bounce back and start grabbing market share in that. This Gen AI is expected to fundamentally change a lot of things in terms of how the work is done in the industry, how the billing is done. And I think the Indian IT companies are already preparing themselves for it. We saw that in multiple analyst meets that we've seen over the past 2, 3 years in our conversations with various consultants and all. And I think that makes us even more positive from a longer term point of view. So I think it's a twin strategy that we are kind of playing it out, that in the near to medium term, the uncertainty which is going to go away from the macro front is going to drive growth in the sector. And from a longer term point of view, I think Gen AI is the one opportunity that we are looking at very positive.
Okay, point taken. Hi, Vibhor. This is Anisha joining in the conversation. But is it fair to pay a price or a valuation premium, valuation which is at a premium to historic averages for a growth which is paltry 3 to 5%? And for even FY26, we're right now questioning whether it's going to be high single digit or we are going to see a double digit.
Fair point. I think valuation is a question which is probably being asked not just from the IT sector guys, but I think almost the entire market. So I think our argument on the valuation front is again it's a twin strategy that we are looking at. One is if you look at the PE multiples, yes, they are definitely higher than what the historical averages has been. But if you look at the kind of growth that we are expecting, yes, FY25 is going to be weak, FY26 is going to be incrementally better than FY25. But the kind of demand environment that we are expecting to come up, the basic thesis that you have to understand is that the growth of FY22 and FY23 would have continued in FY24 and 25 had there not been that weak macro in the US and globally. So what we are expecting is probably a continuation of the kind of growth, maybe not the magnitude that we saw in FY22 and 23, but the direction definitely to be the similar kind of numbers in FY26 and FY27. And then if you look at to take that growth into the account, and if you look at the PEG multiple, the PEG multiples, then you see that I think we are not too far off from the historical multiples. Infosys used to trade at a 1.5 times PEG on a historical basis, and today I think it's between 1.5 and 2 times. Given the kind of opportunity and the growth rate that we are looking at, and we are coming off from a down cycle, I think that is where we find valuation comfort from. The second part that we argue on valuation is that, look, I think the valuations are also driven by the overall markets. I mean, today, which sector, all the sectors or the overall market, everything is trading at a premium to the historical average. Now, will it sustain? Will it not sustain? That's for probably the broad strategist or market pundits to call out. But I think the premium that the IT sector is trading to historical average today is pretty much in line with what the premium that we are seeing for other sectors like maybe capital goods or FMCG or many other sectors as well. So I think it's a market phenomenon. I think we are seeing Indian IT stocks trading at a premium to Accenture. We haven't seen that for a long time in the history as well. So I think it's more of a market dynamics that is making these valuations appear more expensive. Fundamentally, we remain positive that I think we're going to see more growth coming in through. The valuation, of course, can be argued upon a lot, but I think there's still good enough room left on the valuation front itself for investors to make good money out of it.
I like to draw simple data here, which is that look at the deal conversions. The mega deals, fat deals, big deals, dada deals as the IT companies like to call them. There seems to be a decline there, whether it's TCS Infosys or whether it's Wipro or HCL Tech. Why is that? Is this the new normal now?
So exactly what I mentioned in my initial remarks, if you see the deal flow to revenue conversion has been pretty weak for the industry over the past 2 years. And there were two parts to it. One is you were getting new deals, but those deals were being delayed in terms of execution. I think the TCS management summed it up in a very smart way. The CTO wants to give out the project, but the CFO is not writing the check. Now, what's happening here is that basically the deals were being awarded, but in general, when the deals were awarded historically, they used to start execution within, let's say, a couple of months of their being awarded. This time they got delayed, sometimes even to the extent of 2 quarters. Now that was happening because the client, the enterprises, were still coming to terms with the uncertainty in the macro. They were being told they were being told for the past 2 years that there is an impending recession in the US, and we've all been waiting for that recession for over 2 years now. So that led to that uncertainty in their own cash flow, their own business, and that is why they didn't want to take that plunge on the tech spend part. And a corollary to that, they in fact put a large part of discretionary spend of their existing deals, which were under execution, on hold as well. So that is where we actually use this term called the leaky bucket. So this is where you actually had this leaky bucket. You imagine the IT revenue of a company like a bucket, and if the water level rises, then that is the growth that you get. Now, first of all, the water that was incoming, the tap was not fully open. That was because of the deals were delayed in execution. Plus, on top of that, you had holes in your bucket, which was the discretionary part of the existing deals being put on hold, which led to revenue outflow as well. And as a net outcome of these two forces, the water level in the bucket was not rising. This is what I believe the interest rate cut and improving visibility in the macro is going to change. That is going to help the industry gain more visibility in terms of how they're looking at a recession, how they're looking at their cash flows, and how can they time their capex and specifically the tech capex. So as a first step, we believe in FY25, the deals which were delayed will start execution. We've already seen that happening for most of the companies in Q1, and probably we'll see more example of that in Q2. And as a second step, we'll probably see in second half of FY25 or FY26.
Thanks so much then for taking time out and joining in, getting an overall view on all that's going on within the IT sector. But I'm afraid we'll have to wrap it up.
If you like this video, then like, share and subscribe to ET Now.